Most people think banks work like giant storage rooms. You put your money in, the bank keeps it safe, and when someone wants a loan, the bank simply takes somebody else's savings and lends it out. Sounds logical. But here's the strange part. When you walk into a bank and borrow $10,000 for a car, the bank usually does not go into a vault and grab someone else's money. In many cases, that money did not exist before you signed the loan agreement. The moment the loan was approved, new money was created, out of nowhere. And once you realize how this actually works, you start seeing the entire economy differently. Because loans are not just about borrowing money. They are one of the main ways money itself is created, which sounds impossible, because most of us grow up believing only governments print money. But modern money works very differently than most people imagine. And understanding this changes how you think about debt, banks, inflation, and even why economies boom and crash. So, who actually creates money when you take a loan? And what does that mean for your life? Let's break it down. Imagine this. You finally decide to buy your first car. You walk into a dealership. You pick the car. You feel excited, independent, successful. But there's one problem. The car costs $18,000, and you only have $3,000 in your bank account. So you do what millions of people do. You apply for a loan. A few hours later, approved. Suddenly, your account shows an extra $15,000. And psychologically, this feels like somebody gave you money. Maybe the bank, maybe investors, maybe rich savers. But almost nobody stops and asks, where did that money actually come from? Because the answer feels too strange to be true. Most people imagine banks like this. Person A deposits $10,000. The bank stores it, then lends that same money to person B. Simple. And decades ago, that explanation was closer to reality. But today's banking system works very differently. Modern banks do not mainly lend existing money. They create new money through lending itself. And this is where things start getting weird. Let's simplify it. Imagine the economy only has two people, you and a bank. At first, you have $0. The bank has records and systems, but no physical pile of money sitting there waiting for you. Then you get approved for a $10,000 loan. What happens next? The bank types numbers into your account. That's it. Your balance suddenly becomes $10,000. And now, you can spend it. You can buy a car, pay rent, transfer it, use a debit card. To the economy, that money is now real, which means the total amount of money in circulation just increased. Before the loan, $0 existed in your account. After the loan, $10,000 exists. New money was created, not by printing cash, not by gold, not by trucks delivering money, but through accounting entries, which sounds insane the first time you hear it, because we naturally think of money as a physical object, something solid, something limited, something that must already exist before it can be used. But modern money is mostly digital, numbers in bank accounts, and banks have the power to create those numbers when they issue loans. Now at this point, you might be thinking, wait, so banks can just create infinite money? Not exactly, because there are limits, and understanding those limits is the key to understanding the economy. Banks cannot randomly give everyone unlimited loans, because loans are supposed to be repaid. The bank is basically making a bet. They believe you will earn enough money in the future to pay the loan back with interest. That's why banks care so much about your income, your credit score, your job, your spending habits. They are trying to predict your future ability to generate money, which is fascinating psychologically, because loans are really built on confidence about the future, not the present. A mortgage is basically a bank saying, "We believe future. You will be productive enough for the next 30 years to repay this." That's what debt actually represents, a claim on your future labor. And once you see debt that way, you start understanding why loans feel emotionally heavy. Because debt is not just numbers. It is future time already promised away. Future paychecks, future work, future energy. That's why some people feel trapped by debt. They are not just paying money. They are paying future pieces of their life. But here's where the system becomes even more interesting. When you repay the loan, the money can effectively disappear again. Let's say you borrowed $10,000. That money was created when the loan was issued. Now, over time, you slowly repay the bank. As the principal gets repaid, that created money is essentially removed from circulation. So loans create money, and repayments destroy money. This means the amount of money in the economy is constantly expanding and contracting. And suddenly, the economy starts looking less like a machine and more like a breathing system. Inhale, more loans, more money creation, more spending. Exhale, loan repayments, less money circulation, slower growth. This is one reason why debt is deeply connected to economic growth. Because when people borrow more, businesses expand, consumers spend, house prices rise, investments increase. But when borrowing slows, everything cools down, which explains something most people notice, but rarely fully understand. Why economies feel amazing during credit booms and painful during debt contractions. Think about housing markets. When banks are eager to lend, more people suddenly qualify for mortgages, which means more buyers enter the market. And when more buyers chase the same number of houses, prices rise. People then start feeling wealthier. Homeowners celebrate. Investors rush in. Optimism spreads. And psychologically, humans are extremely influenced by rising prices. We assume if prices are going up, things must be good. So confidence increases. People spend more, borrow more, take more risks. This creates a feedback loop. More lending leads to higher prices, leads to more confidence, leads to even more lending. Until eventually, something breaks. Maybe people cannot afford repayments anymore. Maybe interest rates rise. Maybe banks become scared. Then lending slows down, and the entire process reverses. Less lending, less money creation, lower spending, falling prices. Fear spreads. The same psychological loop works backward. Now people panic. They stop investing, stop spending, stop borrowing. Which is why financial crises often feel emotional before they feel mathematical. Because economies are driven by collective human behavior. Confidence, fear, greed, optimism, panic. Money itself is deeply psychological. And here's another strange thing most people never realize. Your loan becomes an asset for the bank, which sounds backwards. For you, the loan is debt. For the bank, the loan is valuable. Because the bank expects future payments plus interest. That future stream of money is considered an asset. This is why banks love lending, especially long-term loans. A 30-year mortgage can generate enormous interest over decades, which is why debt is one of the biggest businesses in the world. Not because banks want your car or your house, but because your future payments create profit. And once you understand this, you start seeing modern life differently. Because debt is everywhere. Student loans, car loans, mortgages, credit cards, business loans. Modern economies run on debt, which sounds scary, but debt itself is not automatically bad. In fact, some debt can dramatically improve your life. A business loan can build a company. A mortgage can help buy a home. A student loan can increase future income. The real danger is not debt alone. It is debt without productive outcomes. Borrowing for assets is very different from borrowing for consumption. And psychologically, this is where many people get trapped, because the human brain loves immediate rewards. A nicer car today, a vacation today, a bigger lifestyle today. But debt pulls future money into the present, and humans are naturally bad at emotionally understanding future consequences. Behavioral economists call this present bias. Your brain values immediate pleasure more than future pain. So borrowing feels easy now, while repayment feels distant and abstract, until the future arrives. And suddenly, past decisions become current stress. This is why credit card debt becomes so dangerous. It disconnects consumption from emotional pain. When you hand over cash, your brain feels the loss immediately. But when you swipe a card, the pain is delayed. And delayed pain feels smaller, which increases spending. This is not accidental. The entire system is designed around human psychology. Banks understand behavior extremely well. Minimum payments, buy now pay later, easy monthly installments. All of it reduces the emotional friction of spending, because the easier debt feels, the more people borrow, and the more borrowing happens, the more money gets created. Now this raises an uncomfortable question. If money can be created through lending, why doesn't society just create unlimited money and make everyone rich? Because creating money faster than real productivity creates inflation. This is one of the most misunderstood concepts in economics. People think inflation simply means prices go up. But deeper down, inflation is often about the relationship between money and real goods. Imagine an island with 100 coconuts and $100. Each coconut roughly costs $1. Now imagine the money supply suddenly doubles to $200, but the number of coconuts stays the same. There is now more money chasing the same goods. So prices rise, not because coconuts became more valuable, but because money became less scarce. And this is why creating money is powerful, but dangerous. If lending grows too aggressively, too much money enters the system. Asset bubbles form, prices surge, speculation explodes. Eventually, instability appears, which is why central banks exist. Now, most people think central banks mainly print physical cash, but their real role is much larger. Central banks influence how easily banks can create money. One of the main ways they do this is through interest rates. When interest rates are low, borrowing becomes cheaper. So more people take loans, businesses expand, consumers spend more, which increases money creation. But when inflation gets too high, central banks often raise interest rates. Now borrowing becomes more expensive. Fewer people take loans, spending slows, money creation slows. The goal is to cool the economy down, which means interest rates are basically like a thermostat for money creation. Too cold? Lower rates. Encourage borrowing. Too hot? Raise rates. Slow borrowing. And suddenly, the headlines about interest rates start making more sense, because they are not just random financial news. They affect housing prices, job markets, business growth, stock prices, monthly payments, consumer behavior, almost everything. But there's an even deeper insight here. Money is not just currency. Money is trust. Think about it. Why does a number in your banking app have value? Because society collectively agrees it does. You trust. Your employer will pay you. The bank will honor your balance. Businesses will accept your card. Other people will accept the currency tomorrow. The financial system works because people believe it works. And loans are part of that trust system. When a bank gives you a loan, it is expressing trust in your future productivity. When you accept the loan, you are expressing trust that future you can repay it. And when millions of people stop trusting the system, financial crises happen. Banks stop lending. People panic. Businesses freeze spending. Because confidence itself is part of the economic engine. This is why financial fear spreads so quickly. Economies are emotional networks. Imagine a business owner hearing recession news. They become cautious, so they stop hiring. Then workers become nervous, so they spend less. Then companies earn less revenue, so they cut costs. Then more fear spreads. Economics is often psychology at scale, and debt amplifies those emotions, because debt creates obligations. Monthly payments do not care how stressed you are, or whether the economy is struggling, or whether life became difficult. The bill still arrives, which is why too much debt can make entire economies fragile. When people owe too much, small problems become massive problems. One job loss, one medical emergency, one recession, and suddenly millions of people struggle simultaneously. Now here's something fascinating. Most wealthy people understand debt very differently from average consumers. Average consumers often use debt to buy liabilities, things that lose value: phones, clothes, cars, lifestyle upgrades. But many wealthy people use debt strategically to buy assets, real estate, businesses, investments. Why? Because if an asset grows faster than the cost of borrowing, debt can actually increase wealth. For example, imagine borrowing money to buy a property. The tenants help pay the mortgage. The property value rises over time. In that case, debt helped acquire an income-producing asset. The key difference is, does the debt create future cash flow or future financial pressure? That distinction changes everything. And this is where financial education becomes so important, because the system rewards people who understand how money works, but punishes people who only react emotionally. And honestly, most people never learn this stuff. Schools teach algebra for years, but almost nobody graduates understanding how loans create money, how interest works, how inflation changes purchasing power, how banks profit, how asset prices rise. So people enter adulthood financially blind, then spend decades learning through stress, credit card mistakes, bad loans, lifestyle inflation, debt traps. Which is why understanding money psychology matters so much, because wealth is rarely just math, it is behavior. Two people can earn the same income and end up with completely different lives. One constantly borrows for temporary pleasures. The other uses money intentionally. One becomes trapped by payments. The other builds ownership. And over decades, those small decisions compound massively. Now let's zoom out. If loans create money, then modern economies are heavily dependent on continuous borrowing. And this creates a strange tension. Because growth often requires expanding debt. Businesses borrow to expand. Consumers borrow to spend. Governments borrow to fund projects. Debt fuels growth, but too much debt creates instability. So modern economies constantly balance between too little borrowing and too much borrowing. Too little? Economic slowdown. Too much? Financial bubbles, which means the entire system depends on managing human behavior. Optimism, fear, confidence, risk-taking. And this is why economics often feels unpredictable, because humans are unpredictable. Markets are not just numbers on screens. They are millions of emotional decisions happening simultaneously. And maybe the strangest part of all this is that most money in the economy exists because somebody owes something. Think about that carefully. A huge portion of modern money was created through debt. Mortgages, business loans, government borrowing, consumer credit. Which means money and debt are deeply connected. That doesn't mean the system is fake or evil. It means modern economies are built on future expectations. The expectation that people will work, businesses will produce, innovation will continue, society will keep functioning. Debt is essentially a bet on the future. And when the future looks optimistic, credit expands. When the future looks uncertain, credit contracts. That cycle shapes almost every economy on Earth. So, who actually creates money when you take a loan? In most cases, commercial banks do, not by printing physical bills, but by creating new digital deposits through lending. And that changes how you see money itself. Because money is not just paper. It is trust, confidence, future productivity, human behavior, and collective belief. The moment you understand this, you stop seeing debt as just monthly payments. You start seeing it as something much bigger, a system that shapes housing, business, wealth, inflation, opportunity, stress, and entire economies. And maybe the biggest lesson is this: debt is powerful, used carelessly. It can quietly steal your future. Used intentionally, it can help build one. Because the real difference is not whether money is borrowed. It is whether the borrowed money creates lasting value or temporary comfort. And once you understand how money is actually created, you start making financial decisions very differently. Not emotionally, not impulsively, but consciously. Because the people who understand how money works usually end up controlling more of it.